When you look at some of the largest investments over the last couple of years, you think of Bitcoin, you think of Ethereum, you look at Tesla, you look at Nvidia, even Apple. They are massive companies that have yielded a very significant return. But is this about really timing the market, or is it about the time in the market, is what we're going to be looking at today. The 7 simple habits that are highly effective for successful investors. Now, when you look at an individual like Warren Buffett, where did he start off? It was a very basic and simple investment and grew over an incredible amount of time. Now, I believe at this point, he's been investing for 50 plus years, which really speaks leaps and bounds about the time that you are in the market versus an attempting to really go in and time the market with the perfect time to buy some of those cryptocurrencies, as well as some of the stocks that we see. Breaking this down, guys, number 1 is investing. Might seem fundamental, might seem super basic, but if you want to be a good investor, guess what? You have to start investing. That means you got to have the money and you have to have the funds to start investing. And this does come with time, but this also does come with effort, because you can get in there and you can start investing. Most places are $5, $10, $15, $25 to actually start investing, and you're building the basic fundamental habit of investing in the stock market. You can start right now. There are a lot of apps that have no commission fees that are very, very low entry point into the market. If you have an internet connection, if you have a smartphone, you can build a portfolio yourself, guys, and start investing today, which is really step 1, guys. Again, this is the fundamental, is to start paying yourself first. Putting money aside and putting money into an investment account does give it the opportunity to grow in the future. Number 2, coming up with a game plan. I advise this kind of right before you start investing, guys, that you know and come up with a game plan of what your goal is. Are you looking at short term? Are you looking at midterm? Are you looking at long term? Are you thinking retirement? Even jotting down notes, jotting down an outline of exactly what you want to build, what the future is going to hold, can really play into where you're going to invest. Again, if you're looking for some short-term gains, it might be CDs, it might be investing in high-yield savings accounts, something that is a lot more liquid that you might have access to that funds. If you're looking for the 5 to 10 year, you could be looking at the stock market, could be looking at bonds, again, kind of those shorter-term CDs. And if you're doing the long play like a majority of us are, you're looking at 401ks, you're looking at Roths, you're looking at IRAs, you're looking at the stock market investing for the long term. Overall, look at your financial plan and also look at your budget, guys. Now, again, this is something very fundamental and very basic, looking at the budget and paying yourself first. So essentially, if you're bringing home, let's say $4,000, $3,000, whatever it may be, a month, if you're putting $25, $50, $100 per month right into an investment account and you're putting it up front that you're investing this money, means that you're not going to see it in the gross income. You're not going to see it in what you're taking home, because that money is already set aside and that money is already invested in the market. This, of course, when you start doing weeks, months, years, 5, 10 years, the exponential growth on this, especially with compounding interest and compounding dividends, is incredible when it comes to the compounding effect that you do have in portfolios. That is what creates wealth, guys, and that is what creates millionaires. Number 3, we get into the savings aspect. Again, if you're not comfortable getting into the investing aspect, the saving aspect is really ground zero. It is the place, guys, where fundamentally, are you putting money into a savings account versus putting it into the market? So again, when you're looking at high yield savings, when you look at any of your financial institutions, including online, they do offer basic savings accounts. Now, with that being said, guys, the yield in these is usually much lower and you're not going to see as great of a return. However, you're going to start seeing your savings build. Again, if you're putting, let's say, $25 in there a week, $100 a month, in the course of a year, you have $1,200 in there. This is the basic of fundamental. This is getting it started. Again, most of us don't have the education and don't have the foundation from our parents. When it comes to savings and when it comes to investing, it really just isn't there through the financial literacy. Well, guys, if you do like the content that I'm throwing out there, go ahead and consider subscribing to the channel. We have a lot more that is coming down the pipeline with the financial literacy and the financial freedom. Number 4, do your research. This is very important, guys. Me personally, I do use M1 Finance. There's a link down below if you do want to start investing with them. But when you look at Robinhood, when you look at Webull, when you look at, Charles Schwab, you got Vanguard, you have M1, you have a ton of places that offer traditional advisors. Even financial institutions do the exact same, but you have to measure up what the risk is and what the fees are associated with that. with the rise of technology and also, a lot of the apps, instant trading is possible, guys, with little to no fees for a majority of traders, especially if you're buying fractional shares, if you're getting into the market and really tracking how your performance is doing. Now, again, with the research, you want to make sure exactly what your goal is and making sure that the goal that you're setting for yourself, again, short term, mid-term, or long term, goes hand in hand with a financial advisor. Because if you're looking to pay for someone, such as mutual funds, which I know Dave Ramsey really does advise doing mutual funds. I lean on the side of ETFs, but I am not a financial advisor. But again, the mutual funds seem to have a little bit of a higher fee, but it is managed accounts versus ETFs, where I just take a broad market range and really invest into all the sectors, including the VOO and the S&P 500, which is one of my absolute favorites. But again, guys, this is the point. You have to do your research. When you look online, when you look at TikTok, when you look at Instagram, when you look at a lot of different social media platforms, guys, you have to know the source of information that it's coming from. I've seen an incredible amount of people, including lawsuits, when you look at investing in cryptocurrency or other things, that a lot of people are being now held accountable for the information that you're putting online. So again, know the source of information, what you're getting it from, do your own research before investing. Number 5, we get into the diversification. Again, when it comes to the mutual funds, when it comes to the ETFs, this is really the asset class, knowing what level of risk you're looking to take and exactly where you want your investment to go hand in hand is what we do with research. And again, the S&P 500, even Warren Buffett, and he is one of my absolute favorite investors that I do follow, say everybody should own the S&P 500. You're talking the 500 plus largest companies in the United States that are grounded here. But you can also diversify this, guys, looking at stocks, looking at bonds, looking at real estate, looking at commodities, looking at cryptocurrency. There's a lot of stuff out there. If you want to invest money and you really want to diversify, a lot of people say don't put it all in stocks. Don't put it all in bonds. Don't put it all in real estate, commodity. Again, cryptocurrency, there are different levels for everything, guys. If you're taking all of the money that you've saved and investing it into a highly volatile asset, just like a majority of cryptocurrencies, chances are you could see your investment go to zero or next to zero in a blink of an eye, which a lot of people have seen in the crypto market. If you're invested and looking to get into something like that, Bitcoin, Ethereum, some of the more core stable, more stable coins. I know they're not stable coins themselves, but some of the coins that are larger market caps that a lot more people have investments into would be, again, doing your own research on that one. Number 6, thinking long term. This is really the definition of, are you trading it or are you investing in it? So again, you have to think of the long-term goals and exactly what you're thinking for. If you're thinking retirement, long-term goal, depending on your age. If you're thinking, paying down some of your debt, if you're thinking of paying for your kids' college, how many years and knowing exactly how long you do have that effort. Now, overall, when you look at the S&P 500, roughly a 10% return, possibly a little bit less if you're taking inflation into account, has been the return. With that being said, guys, this is a point where you can invest into that S&P 500 through a bunch of different ETFs, through a bunch of different companies, but you can put it in there and kind of forget it based on the market and based on the longevity that you're going to have it in there. If you're looking to invest in there in a year or two, be very cautious of investing in the market. We could have another 2022 where we're looking at the market being down roughly 22%. That could make a huge difference. If you're putting, let's say, 10,000 in there, it's down 22%. And then you decide and you need the money after about 12 months, you would be taking and locking in that 22% loss if you're taking your money out of the market. But the good way to think about it, guys, and really the psychological aspect that I put into it is long-term investing, and investing is meant to be long-term. If you're looking for shorter term, you're looking for more things like bonds, CDs, anything that is going to have a guaranteed return. Even though the return might be a little bit lower, you have a guaranteed return and you're not going to be losing money. You're not going to be losing that principal in the short term. For me, I think of it as when the market is down, just like last year, 22%. If you checked out my video on dollar cost averaging and also the one that we're putting $1,000 in every single week into our investment portfolio, it is really the long-term play, guys. If the market is down in a specific week, if it's down 5, 10, 15%, I am super, super excited because then when we put that $1,000 in, we're going to be buying that much more of the equity position in the stocks that we do have and the ETFs, the portfolio that we have. We're going to be buying a lot more of it. And the final one, guys, staying the course. This is one of the most important parts that people need to really live by when it comes to investing is knowing your strategy, following your strategy, staying the course. Again, even if the market is down. So it's kind of crazy to think, but if you really put some time and effort into doing the research, you know that you have a very sound game plan when it comes to investing. For a majority of people, when the stock market is going up, they're buying, they're buying, they're buying. When the stock market starts going down, they're selling, they're selling, they're selling. It is literally fundamentally, if you think about it mentally, you should be buying when the market is going down. You should be selling when the market is going up, or you can hold it and just get some of those dividends, get some of those returns that we see again with the market. You really have to take a step back. And for investing, you have to take the emotional aspect and put it to the side and really take more of the logical approach when it comes to investing. If you are a very emotional investor where if the market's down 10%, you're pulling your money out. If the market's up 10%, you're putting your money in. The stock market might not be for you. Absolutely, guys. You have to know yourself. You have to plan. You have to research. You have to know where your goals are and exactly the roadmap on how you're going to get there with those goals when it comes to investing. So, very cool. Simple habits to cover. But again, I think fundamentally, a lot of people do miss the simple habits because they are so easy to overlook. Even when you look at investing in the market, come up with a game plan, do your research, know where your money is going, know the time frame that you're also going to be investing in it, and I'll catch you in the next video.